There are rules that govern money and nobody taught them to you in school. Not the basic stuff they cover in a personal finance class. Not the tips you see floating around social media. I'm talking about something deeper. Hidden laws, some of them over 300 years old, that quietly determine who builds wealth and who spends their whole life running in place. And here's the uncomfortable truth. These laws don't care whether you work hard, play by the rules, or do everything right. They operate in the background whether you're aware of them or not. The people who understand them use them to their advantage. The people who don't, they pay the bill. Before we dive in, drop a comment and tell me where you're rewatching from and what time it is right now. I want to see how far this conversation is reaching. The first law goes back to the 1500s, but it's more relevant right now than it's ever been. It's called Gresham's Law, and in plain English it says this: bad money drives out good money. Here's how it worked back then. Governments would mint coins out of gold and silver. But at some point, rulers got clever or desperate. They started mixing in cheaper metals like copper to stretch their supply. Suddenly there were two kinds of coins circulating, the real ones and the watered-down ones. What did ordinary people do? Exactly what you'd do. They held onto the pure coins, locked them away, and spent only the fake ones. Now, fast forward to today. We don't have gold coins anymore, but the same exact dynamic is playing out. When the Federal Reserve keeps interest rates near zero and makes borrowing practically free, cheap money floods the system. That flood pushes out the good money, your savings, your financial patience, your discipline. When debt is cheap and savings earn almost nothing, people stop saving. They chase yield. They speculate. They borrow to invest. And who benefits most from all that new money pouring into the system? Not you. The banks, the corporations, the hedge funds, the ones that get access to those dollars first. By the time that money trickles down to your paycheck or your savings account, it's already lost a chunk of its purchasing power. That's Gresham's Law. Running live in 2024. Your dollar shrinks a little every year, not by accident, but because the system was built this way. Now here's where it gets really interesting, and honestly a little infuriating, because the second law explains the exact mechanism behind wealth inequality, and it was identified almost 300 years ago by an economist named Richard Cantillon. His insight: money is never neutral. When new money enters the economy, it doesn't reach everyone at the same time or in the same amount. It flows unevenly, and the people closest to the source get it first. The ground right next to the burst gets soaked immediately. The far end of the field doesn't see a drop for a while. In our financial system, that burst pipe is the Federal Reserve or any central bank printing or distributing new money. When the Fed buys bonds, expands its balance sheet, or cuts rates, who's right there at the source? Wall Street. Corporations with cheap access to credit. Their asset prices go up first. Their stocks climb. Their real estate appreciates. Their borrowing costs drop. Meanwhile, you're at the far end of that field. By the time the new money reaches you through higher wages or tax rebates, the prices of everything you need to buy have already gone up. You feel the inflation before you ever see the benefit. That's the Cantillon Effect in action. And the data backs it up completely. After the 2008 financial crisis, the Fed pumped trillions into the system. The stock market tripled over the next decade. The top 1% saw their wealth explode. But median household income was essentially flat for years. Housing less affordable than it had been in a generation. The same story in 2020. Stimulus checks hit regular households after the market had already started its recovery. By the time most families spent that money, inflation had already eaten into its value. This isn't bad luck. This is a 300-year-old law doing exactly what it was always going to do. So we have bad money crowding out good money, and new money flowing to the top first. But there is a third law that locks all of this in place and makes the gap harder to close over time. It's called Pareto's Principle, or the 80-20th rule. In 1896, an Italian economist named Vilfredo Pareto noticed something strange. About 80% of Italy's land was owned by just 20% of the population. He started looking for the same pattern elsewhere and found it everywhere. In agriculture, in business, in income, in markets. Here's the brutal part. When you apply this to wealth and you leave the system unchecked, the concentration doesn't stop at 80/20ths, it keeps going. It moves to 90/10ths, then 95/5ths, then the situation we're approaching today, where the top 1% controls more wealth than the bottom 90% combined. And this isn't about corruption or some shadowy conspiracy. It's about behavior and compounding. For people who understand how money actually works, who own assets, who invest early, who position themselves near the flow of new capital, they grow their wealth. The people who don't, they slowly lose ground to inflation, taxes, and mistiming. The system doesn't reward effort, it rewards understanding. And since most people never learn these rules, they stay on the wrong side of the ratio. Here's where this all clicks into place. Gresham's law explains why a currency loses value over time. The Cantillon Effect explains why new money always reaches the wealthy first. And Pareto's law explains why, left to itself, that gap just keeps getting wider. Together, these three laws form the invisible architecture of modern finance, a structure so durable it survived the Industrial Revolution, 2 world wars, the Great Depression, the 2008 collapse, and a global pandemic. It doesn't matter which party's in power or who sits in the White House. The turning point was 1971. That's when the United States fully abandoned the gold standard. From that moment on, the dollar wasn't backed by anything physical, just government credibility and the willingness of the world to accept it. Money became pure credit. The supply could expand indefinitely, and Gresham's law told us exactly what would follow. Quality money disappeared, quantity filled the void, savings lost power, and speculation exploded. From 1989 to 2023, the top 1%'s share of U.S. wealth grew from 23% to over 32%. The bottom 50% of Americans gained almost nothing. Every recession accelerated the shift. The math held constant, even as the politics and headlines changed. And look, understanding this isn't cynicism, it's clarity. Because once you see it clearly, you can stop reacting and start positioning. The same laws that widen the wealth gap can actually work in your favor if you know how to use them. Now let's look forward, because these ancient laws are about to shape an entirely new financial landscape. Central banks around the world are building CBDCs, central bank digital currencies. The official pitch is that it's about modernization, financial inclusion, efficiency. But run it through the lens of these money laws, and a different picture emerges. Programmable money means programmable distribution. And the Cantillon Effect tells us who will be closest to that distribution when it happens. Financial institutions, large corporations, early adopters with the right connections. You see the same pattern in crypto. Every major token launch followed the same script. Insiders hold large allocations at near zero cost. As retail adoption grows, new buyers pay higher and higher prices. When liquidity floods in, prices surge. And when bad projects overwhelm the market, as they always do, Gresham's law kicks in. Garbage tokens circulate, quality ones disappear into cold wallets, and trust collapses. The form changes, the function never does. Even the global push toward de-dollarization follows this logic. Nations that have been sitting on dollar reserves for decades are waking up to the fact that the issuer of the world's reserve currency always benefits first. So they're diversifying into gold, commodities, and alternative currencies. Bad money credit, printed without limit, eventually chasses out the good. We're watching that play out on a geopolitical scale right now. And from 2000 to 2023, total global debt quadrupled. Central banks now hold trillions in government bonds. It is ancient. The Cantillon Effect at its most extreme. The Cantillon Effect at its most extreme. The state issues the debt. The central bank absorbs it. Commercial banks use it as collateral. Asset prices rise and wages trail behind. So, here's the part that actually matters. You're not powerless inside this system. But you have to stop thinking like someone at the end of the water pipe and start thinking about how to move closer to the source. Wages alone won't get you there. Wages always adjust after prices rise. That's built into the system by design. What the system rewards is ownership. Businesses, equities, real estate, productive assets that float in the current of new money rather than waiting for the runoff. When the Fed cuts rates and launches asset purchases, corporations borrow cheaply, buy back shares, and watch their stock prices rise. Executives collect bonuses. Meanwhile, the household's savings account earns less. Housing costs more. They take on debt just to maintain their standard of living. That's not a personal failure. That's the Cantillon Effect measured in millions of American households. The practical takeaway: invest early, hold scarce assets, minimize liabilities, and pay close attention to policy shifts rather than political promises. Track where the money flows, not what politicians say about it. When trust in the currency weakens, and history says it always eventually does, people flee to scarcity. Gold surges, real estate appreciates. Equities tied to real productive output outperform. Digital assets with capped supplies attract attention. Every single one of those moves is rational human behavior under Gresham's principle, trading away what loses value for what holds it. And look ahead. If inflation averages even 2% per year over the next 20 years, half of today's cash savings will be worth half as much. If asset prices keep outpacing wages, and they have for 50 years straight, the ownership gap will keep widening. Pareto's ratio will hold. That's not a prediction, that's arithmetic. So let me leave you with 3 names: Gresham, Cantillon, Pareto. Gresham told us that bad money crowds out good. Cantillon mapped exactly how new money flows upward before it spreads. Pareto showed us that without awareness and action, concentration only deepens. Together, these men describe the operating system that's been running beneath every financial crisis, every market boom, and every widening wealth gap for 3 centuries. You are already in this system. Every paycheck, every loan, every investment feeds the mechanism. The question is whether you understand your position inside it and whether you're moving toward the source or just waiting for the runoff. The world is entering another monetary experiment right now. Rates are rising, debt is still growing. Trust in institutions is shaky. These same laws will decide who comes out ahead, just like they always have. The people who learn them early will adjust first. The people who ignore them will notice too late. Drop a comment, share where you're rewatching from and what time it is. I want to see how far these money laws have reached. And if this hit different for you, subscribe so you don't miss what's coming next. Stay sharp. The laws of money never change, only the players do. The laws of money never change, only the players do.